take questions Google form because I am here. There will be many questions which need to be answered. So let's start with the balance sheet. If you have watched the previous video, balance sheet is the record taken from the ledgers. Whatever the balance is left on the ledger, which are taken. There are two meanings of balance sheet. One is there is a balance between total asset and total liability. Simple. That meaning is these are the balances of the ledger. This is for accounting. There are five headings. If you divide balance sheet into two parts, total asset and total liabilities. Total liabilities, which includes the equity and the liabilities, which will be equal on both sides. On the asset side, it can be divided into non-current asset and current asset. I'll just zoom it. Non-current asset are the assets whose life is more than 1 year. So balance sheet, right and left, right side assets, left side equity and liabilities. Asset, non-current asset, current asset. Non-current assets are the asset which has life more than 1 year, which includes property, some goodwill, financial assets which has more than 1 year maturity. Sometime even tax is mentioned here. You can see tax, deferred tax, which is supposed to be paid in next year. Then total non-current asset. And then current assets includes inventory, write down inventory. This is major component for the manufacturing company. And then financial assets. Financial assets includes some investment in other companies. Even companies buy shares of other companies. Investment into subsidiaries or FDs, or even companies buy the government securities. And the cash and cash equivalent. So what is the meaning of cash? Cash means the money in the bank, and cash equivalent are the financial instrument. Write down cash means money in the bank, which actually notes as well. So cash has a meaning that actual notes and money in the bank in current account, and cash equivalent are the financial instrument like short-term government securities or short-term FDs. Those are mentioned here. Sometimes you will find that debtor. Write down the debtor means the person who from whom you will take the money. Debtor. 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 That means company will take money from this, or bill pending. And on liability side, you see the creditor. If you see your own balance sheet, and this is homework for to you to check your own balance sheet today, and you will see the similar entries. Creditor means company has to give money, or some bill is pending, money some vendor has paid and supplied good, and you are supposed to. So trade receivables are, again, money is supposed to come in this current financial year. Cash equivalent is in the bank. Loan is you give the loan and they will pay back, and other financial asset, other current assets. Okay. So here you find the number and you find out the one ratio called as current ratio. It is a current asset divided by current liability. Another ratio called as quick ratio, which is current asset minus inventory. So quick ratio is little more accurate than the current ratio, but current ratio is the popular. Inventory divided by current liability. So quick ratio is the measure, write down. Quick ratio is the measure of cash liquidity in the company to run the business. If quick ratio is less than 1, it is a trouble, which means company does not have current asset to meet the current liabilities. And then company has to take them. So quick ratio should be always more than, and obviously current ratio should be more than. If it is 2, it is good. 1.5 is also good. Okay? But less than 1 is not. So on balance sheet, you see the non-current asset, current asset. On equity side, you see this I discussed and I'm just repeating. On equity side, there are the equities. So these are just numbers. What does equity? Equity means the shareholders' money, whether they have contributed themselves or company earning, but it's the shareholders' right. Suppose if company is liquidated, let's say company is liquidated, and then five Pandavas and government will stand in the queue and they will distribute that money. So the money which will be coming towards the owner is equity. Okay, remember I give an example to understand. If company is liquidated and all assets are sold off on asset side, so there will be people who will be standing uh, to collect that money, and those are the liability people, and those will mention under liability there will be employee payment, vendors payment, distributor payment, then government will be there, and then lenders will be there, and then owner will be. So the equity is the amount owners will get if assets are liquidated, right? So this is a practical definition like Rancho, what is the machine? So instead of telling a complicated definition, equity is the amount of money which owners will receive if all assets will be liquidated, and others will take their other part. For example, total assets are 100 rupees and equity is 30 rupees, and there are liabilities 70 rupees. So if assets are sold 70, see, don't ask question as of now, because when I was speaking, it will create disturbance. So liability people will take first liability, they will take everything, and whatever remain, that will be split. So equity is the amount of money as owners will get if hypothetically assets are liquidated. Under the equity, it is the equity share capital, which is the nominal number, which is the product of face value and number of shares. It is constant unless company increase or reduce the shares. Other equity is the number or amount which is contributed by the shareholders, or it can be generated by the company profit. Equity for the non-controlling assets means the subsidiary. When it is added into the equity. Standalone balance sheet, you may not find this. But equity is the owners. Under the liability, there are two headings: non-current liability and current liability. Non-current liability is the liability which is spread more than 1 year. For example, if you take the loan which is paid to be paid in 5 years, so that will come into the long-term borrowing, okay, or liability, which are usually borrowing, deferred payments. You don't have to go into all this detail. It is not required. What is required is the non-current liability, and understanding that non-current liability has to be paid more than 1 year, 2 year, 3 year, whatever. Then current liability are the liability which is supposed to be paid in this current, which includes the short-term borrowing, short-term trade payable. Now you will notice that trade payable is in the asset side as well. Trade payable means something related to the other vendors. So these are the related to the vendors. So when I speak about this five pandavas, so vendors, distributor, and employee are mentioned into the current liability. So this you feel this statement is very small. It is huge document. This is a very small summary. Is Natasha, my voice lost because someone is see many times it is problem with the people, and it's clear. So current liability, write down who will be the mentioned: distributor payment, employee payments which are pending, and short-term borrowing, vendors. Under the non-current liability, there will be payment of the lenders, even the bondholders. If there are bondholders, they will be mentioned in the non-current liability. Shareholders included in the equity, bondholders included into the non-current liability. So you get these five numbers from the balance sheet. Details of each heading is only intellectual gymnastic. You read from the Google. I don't think it is required small heading. These are the main heading which is more than important. So what are the numbers you will write down from the balance sheet? Equity, non-current liability, current asset, current liability. That's it. There is one more. So five headings: equity, non-current liability, current liability, current asset, non-current asset. Five headings you take from the balance sheet, and then we will start for the ratios. Before that, I'll explain a change in equity statement in a brief. Before that, let's do some ratios here on the balance sheet. So on balance sheet, you take the debt to equity ratio. Debt equity ratio is non-current liability divided by total equity. In a books, that might be different, but at WealthCon, we will take non-current liability divided by total equity. This is the debt equity ratio. And we say debt equity ratio should be less, usually less than 0.3. If debt equity ratio is more than 1, it is little danger sign because your liability is more than the equity. You take the current ratio I mentioned from the balance sheet. Quick ratio you can find it from the balance sheet. Change in equity I just explained in a brief. So business is selling goods and profit expenses are mentioned on the profit loss statement. I told you company raised funds from the one more thing which is selling the shares or buying back the shares, and that will reflect it into the change of equity statement. Sometime company will pay back the loan, even that will be reflected into the equity, change in equity. So change in equity is the comprehensive statement in which what are the things which will be mentioned? It will be mentioned by the debenture payment, share payment if it is received. It is called as security premium. Security premium. Yes, security premium means if shareholder make a payment, it will be mentioned in this column. And then reserve, general reserve, retained reserve. So on balance sheet, we notice that there is one equity segment, and so further split how this equity change last 1 year is mentioned in the change of equity. The change of equity can happen by share buying and selling. So basically, selling happens most of the time. Then repayment of the loan if there is a profit. So retained profit on the profit loss statement will be reflected into this statement. Okay, because it is retained. If there is a loss, what happens? It is showing that annual equity goes down. So if there is a profit, equity goes up. If there is a loss, owner's equity goes down. And there are various reserves as well. Reserve or surplus. Reserve means, as per government, company has to reserve funds for various purpose. For example, if company issued bonds, governments tell them that to reserve some amount for the bonds repayment. Don't spend everything. So there are certain statutory reservations, statutory reserves or statutory reserve, general reserves. So this equity, that means which is parked in some financial assets, which is a reserve money. So reserve money is the money which is not used for day-to-day operation right now. Reserve money is not used for day-to-day operation. It is reserved for certain purposes. You will not understand everything today, but once you understand the framework and things one by one, you will get a concept clear. Okay. So if there is a increase in the share capital, you check this column here whether company how much company received by selling the shares, security premium. Profit for the year, it will be mentioned here. You can see the total comprehensive income. So they are different headings. So all these statements, four statements are interlinked. Value will be reflected into one by. So at the beginning, you see this equity is this, and at the end of this, equity is this. Sometimes equity goes down, sometimes increases. So first is balance, then this is the profit. We discuss in the profit loss statement. Here you will find the dividend. If you want to find the dividend, whether company has paid dividend or not, this is the statement where it is mentioned in the dividend column here. This company has paid 5,000 as a dividend. Probably this is a Reliance. So where to find the dividend? Other equity, equity. And then this is a retained earning. Then this transfer to general reserve, employee stock options, demerger. So now when merger, demerger happens, then change in the equity that will be seen on this. Okay. In one assignment, I showed you that Reliance share capital is increasing and reserves is increasing because there are various reasons of increasing reserves. One is making profit, second is selling shares, third is booking some profit in the asset, fourth is merger and acquisitions as well. So you will understand this slowly. Now one question is why number in brackets? So always remember, if bracket means money is going out, if there is no bracket means money is coming in. Right? If there is minus sign means money is going out. If no sign means money is coming in. So this is related to the change in equity. The another statement we discuss, and it is very easy to understand and useful as well. I gave you a hint as well. Cash flow statement, profit loss statement records all business transaction, includes cash transaction and credit transaction. Suppose what if some promoter manipulate fake business receipt the way Satyam Ramalangan Raju showed. Fake receipt, fake revenue, we really can't make it up. But this cash flow statement is the statement in which actual money recorded in the bank is considered. So imagine there is a glass jar or tank, glass tank. Here there is one opening and money is coming in the bank. So imagine this is a bank account or glass tank. So there is one tap and this is coming from the profit from the operation. Money will come in. What if there is a loss? Money will go out. So there is a glass jar. One tap is coming in the profit. If there is a loss, money is going out from the bank. Suppose if buy the assets, money will go out. So if you do the investment, money will go out. If you sell the investment, money will come in, right? Investment is some land building. If you buy land or building, money goes out. So this is a money or money flow or cash flow, cash and cash equivalent. So this is actual money which is going in. Clear? Operating is easy to understand. If profit coming in, if loss going out. If you buy investment, money will go out. If you sell investment, money will come. Okay. Third is a financing activity. If shareholder buys shares, money comes in. If bondholders or if company takes loan, we'll say this is loan, money comes in. If company buy back, money goes out. Buy back share, money goes out. If company pays dividend, money goes out. If company buy back the bonds, money goes out. If money company pays the interest, money goes out. If company pays the principal payment, money goes out. So this is flow, inflow and outflow, right? Why company buy back the shares? I mentioned in the assignment video. If you watch all video before live session, your life become easy. So this is a cash flow statement. How to read? So you write down this image: cash in, cash out. So there are three main heading. One is operating activities, business activity. Second is investing activity. And third is financing activity. Operating activity, incoming, outgoing. It's a profit and loss. Asset buying and selling. Here there are two headings. One is equity, that is shares, and one is liability. Right? How to read? If you start reading from the first row, it will be difficult. So my way is to start understanding from the below. That means start with the financing activity, which is easy to understand. So find out what are the financing activities. The number in bracket is money going out. So here proceed from the equity share capital. In this they have said that no. That means they don't issue, they have not issued. So here another is issuing the shares from the other company, you can say subsidiaries. So if money is coming from the shareholder, it will be mentioned here. There is one another word, proceed from the right issue. Whenever there is issue, it is means selling the shares. So there is some money is coming from the selling shares. Next is liability. So first they will explain about whether money is coming in or out. So here money is coming in by selling shares. Second, they are talking about the borrowings. When there is a bracket, it means there is repayment. So here there is a repayment, there is again taking in and repayment. So it happens. Proceed means what? Money is coming in. Write down. Proceed means money is coming in. Repayment means going out. So bracket is out. No bracket means in. So this is shareholder related, buying and selling shares. This is liability which may include loans and bonds. Next, again shareholder, if there is a dividend, you can see this is the another number where you can find out whether dividend is paid or not. Cash flow statement. So where to find the dividend? Cash flow statement. Again, this is the again fourth is the interest payment. This is for the loans. So you know that on the balance sheet there was the equity in which shareholder and then liability where loan and bondholder. So same is you can see here interest payment is outgoing, so bracket. Dividend is outgoing, so bracket. So these are the all financing activity. You can find out what company is doing by taking money and sending on the financing activity. I think this is clear. Then now go to the investing activity. Investing activity is easy to understand. A company can buy asset and sell asset. If company buy asset, money will go out. So now this money is going out because expenditure towards plant equipment. Proceed means they sold something and money is coming in. Again, purchase of some investment minus sell. Selling of some financial assets. See, this Reliance has sold financial asset of 5 lakh crore. So they are also doing some trading. So it is not that you are the only people who are doing a business of buying and selling financial instrument. Everyone is doing, including companies. Warren Buffett does the derivative trading, all type of trading. He doesn't tell other investors that he said, I am buy, hold, buy, hold. No, no, no. You see his annual report, he does all derivative trading. Okay. So ऐसे होता है पब्लिक को दिखाने के बाद अलग होता है. So Reliance is also selling some financial assets. Details we don't know what type of assets. Here you will see again investment and dividend. Now you saw the interest in dividend in financing activity, but here it is related to the investing in other companies, and the financing was your own companies dividend and share. This is that means Reliance is getting a dividend from other companies 17 crores and interest from the 11,000 crore interest is getting Reliance is getting interest from the investment 11,000 crore. It might be in the form of bank FDs etc. or government security. Consider 11,000 crore from the interest. So this is the income or expenditure from the investing activity. Now let's go to the operating activity. If you see this number, this will be reflected on the profit loss statement, profit before tax. But what thereafter, what there are some adjustment in which depreciation is added, some adding dividend. Now here you will also find the dividend income, interest income. So this, but these are related to the operational. Okay, so dividend, interest income is seen in all these things, but the, the purpose is different. As I mentioned, individual we can earn from three sources: active income, okay, and trading income, that is business income. Here salary, business income, and capital gain, other income. Similarly, the companies have this different ways. So company can get dividend interest in the business activity as well. They can have the investing activity, and the financing is that they are paying and taking from own shares and bonds. So what number is necessary? This you already got from the profit loss statement. And the micro readings are not important, at least at this juncture. Go to the operating activity and find out operating activity plan. So this is the operating net cash flow. Net cash flow by operating activity is that 1,15,033 crores. Okay, so you get three numbers: profit from the operating activity, and then whatever the cash flow from the investing, and the cash flow from the financing. Okay, so OIF. If operating is positive number, investing is negative number, right? Money is going to buy some, and financing is negative. That means some dividend is paid, tax is paid. This is a good company. Positive operating activity, negative cash flow in investing, negative cash flow in financing. What is bad company is the negative operating and positive is. What does it mean? It means company is losing money in the operation, they are taking money cash flow by selling asset and taking the loan. So this is bad company. So from cash flow statement overview is that you say whether operating is plus and IF is minus minus. That money is going outside, that's it. Second thing you find out the growth rate as well, whether operating cash flow growth is growing or okay. This growth rate are not necessarily important, but operating cash flow. Cash flow is the cash and cash equivalent. So what things you find on the cash flow statement is the dividend. Okay, this document has to be prepared and take the ratios. Right? So I discuss all the four statements what you want to see, and let's go to now theory and understand. Okay, so profit loss statement done, balance sheet done, equity done, cash flow done. Now let's go to the next stage. What you are doing the fundamental analysis to find whether financials are strong, healthy, and growing. The way how many of your pediatrician is writing the chat box? How do we decide baby is healthy? How do you decide baby is healthy? Write in the chat. And how do you decide baby is growing? So consider company as a baby, and we know there are parameters to decide uh, whether healthy or not. When patient or baby comes to you, you in the first visit, you check the parameters and you assess with the some underlying standard growth charts, height, weight, and find out health. Similarly, company life cycle, you try to understand this is important for the making the portfolio. The way human being have the birth, then the growing, and then mature, and the decline. Okay, if you consider 80 years as the standard life, some people may get bonus, but 80, and if you divide, so first 20, first for almost 30 years is the growing of the body. Then for next 30 to 60, you can say mature, and after body and after 60, body start decline. Growth, maturity, decline. Exactly similarly, company and product life cycle, industry life cycle is usually classified as a growth, mature, and decline. Now, there are two ways to look at the companies. And if company is narrow-minded management and it is focused on the product, in a history we will see that each product has its life cycle. For example, once upon a time, Walkman, music, CD, radio, TV. Radio is vanished within 30, 50, 60 years. So each product will automatically obsolete some or other. So in a product life cycle also, it's a growth, maturity, and decline. If any company stick to only single product, that company dies in next 20 to 30 years. So company has the growth, mature, and decline. So company can be classified product centric company, which sticks to only one product, and in that product is absolute. For example, Nokia. Nokia तो क्या किया? So it has vanished because it stuck to the that traditional mobile. However, company can be organization. For example, Reliance, Tata, HDFC. These are the organization. Tata is an organization. Tata can make anything from salt to missile infrastructure or truck, tank. So if company is only product centric, then it will decay in next 20, 30 years. So we need to find out the organization which can switch any product. Dhirubhai started Reliance as a spice trading business. Then they entered into the textile, then petrochemical, then financial sector, then geo, information technology, and all the things. Reliance is an organization. It is not a product centric. Maybe next after 20 years they will start another new product. So such company will be always growing because they reinvent. We need to find out the company which are growing and at least mature. We don't want to invest into the declining. So what are the health related information? So first you have to collect this information. and then find out what are the health ratios. So these are the health ratios: debt equity, current ratio, quick ratio. This you will find on balance sheet. We usually say debt equity ratio should be less than 0.3, but now this is very industry specific. For bank this is not applicable because bank business is taking the debt only. So where you take the non-performing asset. Your non-performing asset should be minimal and maybe less than 2, sometimes less than 1. Industry specific, but you know that debt equity ratio should be low. Absolute number may vary. Tomorrow someone say, but sir, debt equity ratio is 0.83. Should I select or not? So where you have to use the common case to case basis common sense. These are the guidelines. Numbers are the guideline. This is not the absolute value where means restrict to less. Current ratio obviously more than 1 and quick ratio more than 1. Operating profit margin. I told you EBITDA margin is operating profit divided by sales into 100. Okay. It should be minimum 20. If 20 is then good. But what if 20 less than 20? Then we use the MD Sport criteria to average out what happened in last 5 years. Single year may not be enough to give a clear idea. Then net profit margin. If it is more than 20, it is certainly good. Return on equity is the ratio calculated by the profit after tax divided by total equity and multiplied by 100. Return on capital employed. Again, this might be different on the Google. Stick to the Welcome definition. It's a profit after tax. It's written like this: profit after tax, total equity plus non-current liability, and then 100. More than 20 is certainly good. Even it is more than 10, it is adequate. Return on asset is another parameter which is used from the bank, in which you take the ratio of profit after tax, total asset. Okay, if it is more than 10, it is good. For the bank, it might be less. Even 2 is more than enough. So these are the ratios which you decide the health. Now these are industry specific as well. Okay, this is net profit margin, operating profit. These are the health ratios. I told you general outline. When you start studying yourself, you might find industry specific and based from that industry, which is the best. Growth parameter. These are the health parameters. So what are the bad health parameters? Is the quick ratio less than 1? Bad. Debt ratio, D ratio more than 1, it's bad. Profit margin, operating profit margin less than 5, net profit margin less than 5 is return on equity here less than 5, it's bad. Return on in general, see this will be industry specific. When you are going to study, you will find out which is the best company and you correlate with other. This 5, 6, these are just a number for your understanding. These are not absolute guidelines. Then growth parameter, you have to find the sales growth rate, EBITDA. Now it's very easy to calculate from last year to present. One number here, it's a book value. What is a book value? Is total equity divided by number of shares is the book value. Okay. The way we have the EPS is the profit after tax divided by number of shares is the EPS. Similarly, total equity divided by number of shares is the book value. Total equity is also called as net worth. How much the net worth of that company? Book value is the net worth divided by number of shares. Why book value is important? Because there is another ratio in the valuation where it is called as PB ratio, price to book value ratio. So how much should be the growth rates? Usually we say growth rate 20% in everything is good. Less than 5 are not good. So I keep range for the 5 to 20. Okay, some companies might grow 30% as well. This is the range where company will the rate will fall. Less than 5 is not poor, it's poor growth. So you have to find the growth rates, you have to compare with the previous years, and then we decide the growth of the company. Till now, we were discussing quantitative analysis, numbers, numbers, numbers. Now, this is the where quality, stories. You divide promoters into different class because when you are putting the your money, there is a metaphor that company is the horse and promoter is the jockey. We need both. Jockey should be good and horse should be good. What if jockey is Anil Ambani? Even business or Reliance Communication was good or other things were good, but jockey was blunder. So jockey should be good. So how do we divide promoters? This is my definition, my classification. Sarkari companies, that means promoter is the president of India. That is government companies. Examples are SBI, Coal India, ONGC, oil company. Then India is full of dynasties. Dynasties पहले भी थे राजा महाराजा अभी भी है. Political dynasties, business dynasties, film industry dynasties, and everywhere dynasties. And this is one type of reservation people don't speak about. There is a reservation at top as well, where political people have the reservation for their children. Business people have reservation for their what qualification this Isha Ambani and Anand Ambani has, except Ambani. There are so many people who are more qualified, but they have the reservation. This is not critical, but just understand the concept of dynasties and the reservation pattern. Reliance, Tata, Bajaj, Birla, Godrej. Can you tell me some more dynasties you are aware? I'll write here. Tell me the multinational companies which are run by the professional manager, not a dynasties. HDFC, Nestle, L&T, Colgate, ICICI, and then startup. These are the run by the recent people who are seeking they are focused more on selling the shares and taking the funding from the investor and less focus on the producing the goods. So I classified promoter institutes. Can you even write the some dynasties जो जिसमें नहीं है वो लिखो. पिरामल है बराबर राइट. पिरामल महिंद्रा अडानी अभी डायनेस्टी नहीं बोलेंगे बिकॉज शी इज द फर्स्ट जनरेशन. डायनेस्टी शुड बी एटलीस्ट सेकंड जनरेशन जैसे टाटा बजाज विप्रो टीवीएस. ओके टेल मी द सम एमएनसीज multinational companies. MNC. Infosys also now multinational companies. HUL, Hindustan Unilever. Why I am talking this? Because the MNCs are global operations. They are in good corporate governance, which is very important factor for long-term growth. ITC. Sarkari company are not good for the growth, but they are good for the dividend. Sarkari companies are good for the derivative trading. So don't neglect Sarkari. SBI, ONGC, Coal India, they are very good for the collecting the dividend and doing asset covered call. We prefer to stay away from these startups because most of them probably will wind up the business because their business model is not actually creating profit. So we focus on this. Why? Because you can create a portfolio based on this as well. That I want only stocks of MNCs and dynasties. I will not search anything else. Find out the dynasties, find out the MNCs, build the portfolio. Very simple. Then, while you are studying the annual reports, you will understand the products, business products as well. So, products can be, as I mentioned, there are product life cycles. So, products can be goods, services, trading, agency, bank, insurance, holding, plus profit loss statement of each product will be different. Balance sheet of each company will be different. IT company balance sheet will be different from the goods producing. Banks will have different. But once you start reading annual report of each segment, you will try to understand how to correlate the things. So find out whether product is sustainable or not. Whether product is consumer good or business good. Consumer goods mean direct. We are selling to the customer fast moving consumer, eating, detergent, cleaning, washing, cooking, and all the company business goods means if they are selling machines to other company. It's a Siemens, Tata Elxsi. Other company is in commodity business because commodity business is very risky. It's a price sensitive. If someone comes with the lower price, business goes out. Whether company is selling the branded product or prestige goods, Titan, Apple, Mercedes. If company is selling the Eicher Motor, no? Bullet. So there will be always market for the prestige goods, and there is brands so they have better margins. Whether company is selling the products which are price sensitive. If it is price sensitive, they can wipe out slowly. So this is the understanding of the products and the classification. So today in the first second session, I discussed the second and third hour financials, promoters, products, financials. I discussed four: health ratios, growth ratios, and all four statements.